you've got somewhere in the range of 250 billion still to 375 billion of defaulted mortgages. Still a very small number in comparison to the market. And so it has been tough. But that's all changing. And every 1% move is another 120 billion with a B of new defaults that are coming to market. So we're starting to see that trend go in the other direction. And it's like, I've just got my popcorn ready.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Bill Bymel is the CEO of First Lien Capital LP. It's a privately owned distressed mortgage investment platform he founded in 2021. They currently own over 700 residential mortgages valued at over $65 million in assets under management. Bill, welcome to the show.
Great to be with you, Sam.
Absolutely. The pleasure is mine, Bill. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Wow, 90 seconds or less is the hard part. I started as a residential fix and flip investor in the early 2000s in South Florida. I've been a broker in Florida for years. I live in California now. I built that up, got into commercial real estate, buying and selling, brokering as well. And then when the GFC hit, I got a random call from a asset manager in Southern California that said, I can buy mortgages for pennies on the dollar. That was my light bulb moment. That was 3 months before the fall of Lehman, the summer of 2008. And from there, I went on to say, I'm going to do this for a living. And for 15 years, I learned how to buy and sell mortgages, work them out, and really kind of created a new paradigm for how to work with distressed borrowers in the residential real estate market. And I've done this to the tune of several hundreds of millions of dollars at other institutions, the number 2 guy at a New York private equity firm. And then a couple of years ago, I was the baby bird leaving the nest and started First Lien Capital with the goal to build it to a $500 million company.
Wow, that's really, really cool. I love that. So just to clarify, you went out and worked for another firm where you kind of cut your teeth learning this business. It sounds like that is an effective strategy to really get into what you're doing. Would you recommend the path you took, or is there a better way to get it done?
You know, it's very interesting because the secondary mortgage market, which is where we play, that's how we access our product, buying and selling.
Right.
You know, that's where big pools of mortgages are traded, as well as small individual loans. This is a good old boys network, right? And since the 2008 recession, there's been a lot more access to it. There's almost like a tertiary market beyond the secondary market. Smaller investors trading due to the internet, due to the availability of communications. That said, the main secondary market remains a good old boys network. So yes, if you can I'm always a big believer in finding someone with the knowledge you seek and have them be your mentor. So I met a guy named Pete Slagowitz back in 2010. At the time, I was buying small deals and trying to build up, and he had just raised his first $50 million, and he was a mortgage investor with experience at UBS and all the big New York houses. I was like, this is a guy I can learn from, and he could learn from me because I knew real estate.
Mm-hmm.
And we teamed up for 10 years. I was his number 2. I did all of his Florida stuff. And it was through that mentorship that I gained access to the people that you need to know how to work this very nuanced business. You know, it's really taking a Wall Street private equity institutional world and bringing a Main Street approach to it. You know, it's kind of combining those 2 things in what we do. So I highly recommend finding someone.
Absolutely. No, that's great. I love the way that you've done that. It is a good old boys network, I feel like, and maybe it's just because I run a podcast with 800 and something episodes, but I feel like it is at this point, it's become more mainstream. Like more people understand it. I mean, I don't think before, and of course I was probably too young. I went through the 2008 crisis. I owned a business then, but I didn't understand kind of conceptually how all this was traded and kind of the like you said, the tertiary.
That's exactly right.
Right. But I feel like more people have an understanding of what a mortgage is now, how they're bought and sold.
Right.
We've had, just obviously up until now, we're recording this June 13th, 2023, but we've just had a booming economy for a decade or more. Has the distressed mortgage market, has the pool of available loans shrunk over the last
Oh,
decade?
absolutely. Absolutely. It has been very difficult to be a distressed mortgage buyer the last couple of years when there's been no distress.
Right, right. So what
You
did
know,
you do?
I sought, so the way I made my mark the first 2 years of this, so there was some unique opportunities in play with COVID. When COVID shut down courts in this country, a lot of the guys, my competition in the business, really freaked out because if you already owned an existing pool of mortgages that were nearing foreclosure, and all of a sudden the courts closed that down, now they had no timeline to exit these things they thought they were a year away from. So I got a lot of deals in the last few years buying my competitors' tails, stuff from old funds, buying up other people's problems, and I have the experience and the knowledge and the comfort to really analyze all of those on a one by one basis. So we really hit it out of the park that way. So part of this business is kind of shifting with where the opportunity is. Prior to COVID, it was scraps. We didn't grow too big, so there just wasn't enough volume in the industry. But keep in mind how big the residential real estate industry is. $12 trillion of mortgages in America. And we're at our lowest, obviously our lowest default rates on record, somewhere between 2 and 3% right now. So that means that you've got somewhere in the range of 250 billion still to 375 billion of defaulted mortgages, still a very small number in comparison to the market. And so it has been tough, but that's all changing. And every 1% move is another 120 billion with a B of new defaults that are coming to market. So we're starting to see that trend go in the other direction. And it's like, I've just got my popcorn ready.
Right, which I know what you mean when you say that, because I think we understand the pain that brings to families, to
Yeah,
the people affected by it. So I don't hear you in any way being like, oh, hey, I wish that more people would have distress on their mortgages, because we don't. But
right.
yet at the same time, you play a very vital role in just how this economy functions, and helping keep things liquid and things moving. So I get
100%.
it both ways. You're getting your popcorn out because it's like, well, this is kind of what we're poised for. Unfortunately, you're poised for the downturn, and
Right.
that's where you make your money. So I mean, that's part of it. But I want to find out. So you said that the last decade's been tough to be in the distressed mortgage business, but yet you guys, what was your competitive advantage, and how did you underwrite that? I know I'm not supposed to ask multiple
Sure.
questions at once, but you got all your friends who are like dumping off their kind of tailings of what they had, going, all right, this is no good, that's no good, and you said,
Yep.
wait, there's opportunity here. So what was your competitive advantage there?
Very good question. So I wrote a book about this. Obviously, I'm not obviously, but I mentioned it to you earlier,
Right.
called "Win-Win Revolution." That and it's really details the paradigm by which we operate. When we put this paradigm into place over a decade ago, and in many ways, it revolutionized our industry. I have competitors of mine that tell people, that take my book and give it to their new asset managers, because the whole idea is to meet the borrower at their level. I got it. Nobody wanted to, I don't, didn't get into this business to become a debt collector. That's not of interest to me. I like real estate. I know how to value real estate. And I know that that it's a very safe investment, because if you're buying a note, as long as it's based upon a true value of the real estate, you can't lose money. So from my perspective, it was the best risk adjusted return investment. Now, if I buy these mortgages at a discount, I can now share some of that savings with my borrowers. We turn around and instead of calling this borrower up and asking them for a payment, we ask them, they're flabbergasted because they get a call from us saying, how do you see this resolving? What would you like to see happen? If there's an opportunity to modify someone, in the old days, we were giving huge principal reductions because people were underwater. And that was phantom money to us too, because we were buying the mortgages at a discount. We were able, like you said, we provide a very vital role because as private equity, we have so many more tools in the toolbox. We take the first 30 to 40% of every pool we buy and reperform those people, give them modifications. If someone has the ability to pay and the intention of keeping their home, we will do whatever we can to make that happen. And for that middle 50% where maybe they've just priced out, their situation has changed, whatever it might be, we want people to exit with dignity. So we'll give people a waiver of their deficiency balances. We'll help set them up in a new rental property. Rather than spend money on an attorney to foreclose, I'd rather pass that savings back to our borrowers. So that's really how we revolutionized the industry. And that means, we do this through the help of our local real estate broker network and our mortgage brokers and people on the ground who are knocking on doors and letting people know, hey, we're not Bank of America. You should talk to these guys. And that gives us the competitive advantage that others in the industry can't do. It's just not, it's such a big industry. Most can't get that granular.
Right. Most can't get that granular. I think the one key that gives you the margin in these deals to offer that flexibility is buying at a discount.
Correct.
Like you have to buy, and I'm telling you things you already know, but when you're buying at a discount, as you mentioned, for the last decade's been tough. I mean, 'cause people are bidding a lot of these pools up. And if I'm incorrect?
Yeah, no. So the last 4 years have been tough. I mean, we had a good run up until about, I would say 16 is when the market, right around the time Goldman did a deal with the federal government, where a big settlement over the last foreclosure crisis, they made a huge commitment of dollars to buying mortgages, and part of their settlement with the federal government allowed them to buy defaulted mortgages and modify them and get a credit against their settlement. So they've been the biggest player in the market the last 4 or 5 years. And then there's another woman who's bringing money in from Asia that's been overpaying for stuff. And there was a number of investors that were highly leveraged with very cheap capital up until a year ago that were also forcing the price of NPLs up. That said, they were always still trading at a discount, but you'd see stuff trading at, in the 80s or 90s, not enough of a discount that we could really make our mold. So we ended up focusing on harder to work areas like New York, New Jersey, Florida, where they're judicial foreclosure states. A lot of the large institutional investors stay away from the judicial foreclosure states, or will bid those down or just not bid them at all. And that's where we've been able to find opportunity and still find discounts over the last few years.
That makes a lot of sense. How do you underwrite that many deals at scale? If you do it at scale, or is it an individual loan by loan analysis? And if so,
No, it's a good question. We've developed a model for over 10 years. It's a sophisticated yet simple discount model. So think of it like this. It's done on a loan by loan basis but we get the data that the servicer gives us on any pool, and we're able to VLOOKUP it into our model. And what you're in essence looking for is, what am I going to get if I have to take this to worst case scenario? I have to take this property to foreclosure. How long is it going to take? What's going to be my cost to carry the money? What's the cost, the rehab, potential rehab, legal expenses, the cost of insurance, property taxes? All of that gets discounted off along with a timeline and what your projected yield is over that 2-year period. Let's say, 15% per year. And that's how the model determines what discount I should be offering on any individual loan. And believe it or not, even with that, this model, like if you get an old loan that's late stage foreclosure, my model might say I can pay 105% of UPB for something like that, because if it's been in foreclosure for 2 years, then you've already got another 10 or 15% in debt that's built up above your principal balance. So, it does work both ways, but most of the time, we're bidding in the 60s or 70s of value.
Do you mentioned popcorn earlier? Are you expecting that bid percentage to come down in the near future?
Yes.
Why is
100%. So what's happened is I've been able to consistently find deals in a mid-teens yield while the rest of the market is bidding large pools to high single digits yields.
Mm-hmm.
And what's happened now, as in the last year, as the adjustment in rates has happened, everyone's expectations has now shifted into double digits, the regular market. And so we're now looking at deals that are in the 20s minimum 20% yield. And it could get better, especially if we dip our toe into commercial stuff. In commercial, we should be modeling in the 30s. I mean, there's a bloodbath on the horizon there.
Well, certainly in the office
Yeah,
sector, there's a bloodbath
that's right.
on the
That's right.
horizon. So yeah, that's very interesting. What is the? I guess there's two questions I've attached to this. What is your disposition strategy once you get the loan performing?
Oh yeah, good question. We do have. That's why the secondary mortgage market um, connections are so important. So we're able to pool reperforming pools, minimum about $10 million. Sometimes you get a buyer at 5, but the institutional guys will securitize reperformers in with new mortgages
Mm,
as they're building these. As these aggregators come back to the market, once the rates seem to level off, then you'll see a lot more of these securitizations come back, or institutional buyers will just buy it to clip a coupon.
sure.
So reperformers now will traditionally not sell for par, but they'll sell in the 90s of their principal balance. So if I'm buying in the 60s, I'm taking in 6 months of payments, and I'm selling in the 90s. You do the math. It's actually one of the best return across the board in our portfolios have been deals that we've modified and resold.
Oh, sure.
And it's a win-win strategy. So it's like, I just love it.
Absolutely, absolutely. So I guess that's the last question attached to that is the seasoning period. 6 months, 12 months.
6 months seasoning just to resell a loan and have it. 3 months is of payments considers it a reperforming loan, but most buyers in the market want at least a 6 month seasoning.
Oh, I would think so. I would think so. So you repackage these and you sell these off to aggregators, then
That's
five,
right.
$10 million at a time. Can you take debt on your fund? Is there debt for acquiring debt?
Absolutely. Absolutely. So it's very interesting to see how that market has changed.
Yeah.
Those of you who have watched the news recently know the name PacWest Bank. PacWest Bank owned two lender finance companies,
Mm,
where they had their own internal lender finance, and then they had another capital solutions out of DC that they had acquired a couple years ago, 5-10 years ago. They were one of the larger players in the debt on debt space.
mm,
So just as an FYI, now they're out of it now. Thank
right.
God I didn't take the line of credit they were offering me last year, because it was attractive last year at a 4.5, 5.5 rate, but they're floating rates.
Right.
I would have been sitting on a 10% loan. So now the debt on debt still exists. Credit Suisse is obviously most famous for it. It's interesting that the names that were bubbled about as being problematic recently are the guys who were debt on debt.
Right.
But those guys, and there's a number of them still out there. Western Alliance was another one that's dead on, that does lender finance. You absolutely can do it. We could do it. We try not to leverage ourselves. We try to stay all equity, but we have that option. And where we're at right now is that the leverage on leverage options that are out there, it used to be if I wanted private equity, I'd have to pay minimum 10% or so, and I could get the banks for 5, 6. Now the banks are 9, they're SOFR plus 450 or 500, so it's close to 10% money at the banks as well. So you're almost better off doing. Now the private guys are trying to push into low doubles, but they'll still take 10% probably if you have a relationship. So you're actually better off leveraging through private equity right now.
Right. And does that PE come in as debt or do they come in as equity?
All of my private equity money has come in as equity so far.
Right.
I've got I do have, it's funny, my main private equity partner is a big, billion-dollar institutional group out of New York, and they pursued me as debt for a year, and I just, that wasn't the kind of relationship I wanted to have.
Right.
So I prefer to have all equity, have us all just have, all of we're all vested in it together, para pursuit.
And shoot, man, I love the idea of limited to no debt, because it just leaves the toolbox. You leave every tool in the toolbox to really do what you want without constraints.
That's correct.
Do what's best for best for the fund, best for the investors, best on the return profile. It just leaves you much more nimble. Absolutely love that. Let's talk here the last 60 seconds or so that we've got here on the show before we get into how to contact you and to get in touch with you. Let's talk about raising capital. I mean, it's something you've got a lot of experience in. What's it been like raising capital for the non-performing loan space?
I'm an asset manager by trade and a deal guy. So learning to raise capital was going back to school.
Mm.
It was 6 years ago at my previous firm was the first where I had to first do it. It was, one of our main capital partners was starting to pull back. And so I had to learn how to go out and brand ourselves, package, talk to investors. And it has been very educational and wonderful, and yet not easy. The persistence is the key, especially with large dollars. I've got a gentleman, for instance, right now, a multi-millionaire I have been pursuing for 5 years, and he's about to write his first $1 million check this week. And it's persistence. It is, being, the strategy, perfecting our pitch for our strategy has been fine. I think everybody who gets real estate with a little bit of nuance or a little bit of sophistication likes the uniqueness of our strategy and sees the soundness of it. But raising capital is it's a whole different career. And I may look back on this and say, it was worth it because of the money. And I may just say, I like doing deals, and I'm going back to just doing deals. We'll see.
Right. But I think the one interesting thing in all of that, despite the challenges raising capital, the temptation to have your $1 billion fund or $1 billion PE firm that says, hey, we want to come in as debt. I mean, that's low hanging fruit for the guy out there raising capital. And yet you had the patience and the discipline to say no.
Yeah.
Not the way we're doing business. So I think that's really, really cool, and an awesome part of your story there to point out. Bill, if our listeners want to get in touch with you, learn more about you, and or get a copy of your book, Win-Win Revolution, what is the best way to do that?
My personal website is billbymel.com, BILLBYMEL.com.
Fantastic. BillBymel.com. We'll make sure we put that there in the show notes. Bill, thank you again for your time today. Certainly appreciate it.
Great to be with you, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.